there is serious momentum in the market and it's only going to get better. Coal is a big talking point right now. So what we say, like, coal, 2023 stock of the year.
If you had to have a tip now, where do you reckon that we're heading for Australian miners?
I'm still a bull. I will be probably for the next 6 to 12 months. Like, investors are getting it wrong so quickly. So you can't help it as an investor. You go, oh, I'm going to lose all my money.
Market analyst at Bill Direct, Grady Wulff, joins us now. Grady, good to see you again.
Good to see you, Koshi, as always.
This week on Your Wealth Playbook, we had an exciting guest, Grady Wulff from Bell Direct, a senior market analyst talking all things markets, Australian markets. Gold miners has been on an absolute tear. Grady dives into her hottest stocks, where she thinks the market is heading to, the risks that she sees for the outlook in America and Australia, and her tips coming up for the next 3 to 5 years with specific stocks. It should go without saying, this podcast is definitely not financial advice. Grady and I have not assessed your personal financial circumstances. Yes, we do speak about specific stocks for research purposes only. Please do your own research. This is definitely not financial advice. Dig into the episode. Grady, for someone who is new to investing, looking to get into the equity market, what's one thing that they should be looking for?
Research is key, and being in the know and on the know is always so important. So you look at the markets and it can be so overwhelming, and knowing the right advisor to see, knowing the right advice, knowing the right where to start, and it's setting your own boundaries, setting your investment goal and saying, yep, this is my risk appetite. I'm an income investor. I'm a growth investor. This is what I hope to achieve. You set those goals, obviously, with people like yourself. And it's the way forward is knowing exactly how to navigate the market. So following investment talks like what we're doing right now and knowing the research and staying on top of the game is just the perfect way to start. Because as someone who previously had no knowledge of the markets, you can literally rock up and go, too hard basket, put it in the bin. And we saw so many people go dormant after COVID. A lot of people went dormant because obviously they started betting on the markets when sports stopped. So those people went dormant because they didn't understand the markets. So it's research is everything and knowing where to start.
You talk about research. Financial literacy, I believe, especially as an advisor, should be taught in schools.
Yes, I agree.
It's not. How does someone find some research? Obviously, Bell Direct do some amazing stuff. You put out some cracking content.
Thank you.
Yes, but if I'm purely looking to get into the Australian market, looking for research, what should I be looking for? When you say research, break it down for me. Where do I start?
So through yourself or anyone who's trading with Bell Direct or Bell Direct Advantage or any of our platforms like Desktop Broker, you get access to Bell Potter Research, which is a team of research analysts. What they do is they constantly update stocks that they're investigating. They go through the financials, then do fundamentals, they then do macro impacts and deliver you with a buy, hold or sell rating and a price target for the next 12 months. Constantly updated. I've actually started working with that team myself because I just finished my 3rd degree and now I can value stocks myself, and I'm absolutely loving it because you can kind of look at the market and go, why is Pro Medicus on a 300 times PE when its actual valuation set and the fundamentals and financials say it shouldn't be on that? But then you look at it and go, okay, there's tailwinds, it's a leader in its space, it deserves that PE because as long as earnings are growing, you're willing to pay that premium. So there's a lot at play.
Yeah. If I'm someone that's new to investing and you've just spoken about PE, what is PE? Obviously, it's price to earnings. And for
price
someone,
to earnings, yes.
And someone that has got no idea, price to earnings is generally, I'll break it right down. If a stock earns $10 for the year and it's priced at 10 times earnings, well, then it'd be priced at $100 a stock. Yeah,
so every $1 of earnings is what you're going to pay based on the share price. So price literally what the share price is to the amount of earnings they're earning. And so 300 times, obviously it says 300 times is what you're paying for the earnings per dollar. Yep. So that's quite an extravagant number. So what I've seen recently, PE used to be kind of the be-all and end-all metric. It used to be, if it's not in this range, so a growth stock should be over 20 times, a staple stock's within like 5 to 15 times, and then you've got your banks, which should be trading under 10 times, but CBA was the most expensive bank in the world recently. So that just speaks to the point that PEs are kind of gone. Like, you need to keep an eye on them, but we're in a momentum market, and at the moment PEs are not as relevant as they used to be because you're seeing companies that are pre-revenue on PEs that are ridiculous and multiples that are ridiculous. So you're looking at it going, should I buy in? And the investment opportunity and the compelling investment story is there. But if you're just going on PEs, you won't buy in. So it's one metric to consider and keep an eye on so it doesn't get stretched too far. But stock valuations are kind of through the roof right now. So it's not really the be all and end all right now.
Yeah. Markets are at all-time highs.
Yeah.
And you speak about PE, and momentum was another one
Yeah.
where we are in a momentum market. And
We are.
traditionally, tech stocks have been, their PE ratios are, usually through the roof because everyone's forward-looking around what their earnings are going to be.
Correct.
You think about, the Mag 7 stocks.
Yeah.
In Australia, though, we haven't really had those type of, PE ratios that high, though.
No, not really in tech. And so, well, Technology One's one that you would see kind of a SaaS business, and that has had a high PE recently, and that's why our analyst went to a hold. But you look at a Life 360, and what I found from reporting season recently was as long as companies met expectations, mind you, the bar was really low, as long as they met expectations, they were able to continue the momentum in their share price, and investors were overlooking PE ratios to go, yep, the momentum's there, growth is still on the horizon, outlook is good, buy.
Yep.
And so while the bar, as I said, was set low, it's simply incredible how valuations are going. And I still think there's steam in the market.
Yep. And, talking about that momentum now, markets are at all-time highs. We've still got, we had the Reserve Bank yesterday,
Yes.
hold rates.
Yep.
We've got the Fed in the US cutting rates.
Yep.
They're going through an easing cycle. Inflation's still at the top of the range for the RBA.
Yep.
How is it still a momentum market at the moment?
Yeah, so it's very interesting question. It's all to do with the growth of earnings outlook. So what we look at is we've been through FY25, which was a pretty hard year. You had macro headwinds, you had Trump, tariffs, taxes, geopolitical tensions, wars. You had China's economic rebound has been really subpar, and we're still waiting for that material stimulus from 2 years ago that just hasn't come through. So that was a tough year. And those companies who made it through that year and are guiding to a stronger year, so mid double-digit earnings growth, that's where we're seeing the momentum come through, and that's where the valuations are. So we expected low single-digit earnings in FY25. If they didn't make that they were heavily punished. So you look at companies who had margin pressures, who had lower sales, higher inventory for the retailers, or really disappointed the market. And you have the other ones like your niche retailers, which we'll get to later, who Baby Bunting, Nick Scali, JB Hi-Fi, margin appreciation, inventory under control, debt under control, free cash flow, strong profits, Bob's your uncle. So you look at it and you go, yeah, it's still there. And with interest rates easing and the outlook for the RBA to keep cutting next year, you go, okay, there is serious momentum in the market and it's only going to get better.
Yep. I think I've seen a stat that, I know this is the US, but we generally follow the US in markets. Fed cutting rates, as soon as they do, markets were on average up the following 12 months. Something ridiculous like 14% or something like that. So
nuts, yeah.
Wild. So when you're talking about momentum, there's obviously that, but there's still those macroeconomic factors playing in because we've still got those geopolitical, who knows what Donald Trump's going to do.
Or the shutdown potentially tonight.
Well, there is that, yes. Not funding healthcare for illegal aliens or whatever he calls them at the moment. We've still got war raging on. But in Australia, you're talking about momentum and the materials sector, or mining in particular, has been smashed. Commodity prices, you mentioned lithium, has been absolutely smashed.
Yes.
Do you see that rebounding at some stage with this momentum picking up?
Absolutely. And I think we're starting to see that right now. So gold, we were speaking about off camera, I called it December 2023 simply because of the safe haven nature, producers coming online, China and the central bank buying. There's a lot of tailwinds there, but those were the key drivers then. And now central banks buying even more to diversify reserves away from the US dollar reliance, which is weakening. And you look and you go, there is so much momentum in this market. And also with materials, as you mentioned, there is so much diversification. So you look at BHP expanding, they're really going hard at the copper play. You've got Rio now in the lithium play. And so the bigger blue chip miners are really looking beyond what their core strategy used to be, which was just iron ore or just oil and gas. And now they're going, no, we need to be part of this green energy transition. So diversified earnings, geographic diversified earnings is really important as well. And we're seeing that play out through lots of different sectors. So like even today, for example, Eagers Automotive going to Canada, acquiring a company in Canada to expand their earnings to Canada in a growing market of vehicle sales. Like, you just got to look at this world now and go, where are the opportunities? Where's the growth? And as long as there's growth, these companies are going to go after it.
Yep. Australia traditionally has always been heavily in mining, naturally, one of the most resource countries in the world.
Yeah.
BHP, for a long time, I grew up in Singleton, so may have a little bit of bias around this, but they've been transitioning out of coal for that, new green energy that they're looking for. So other minerals that they're getting into, when you're talking about diversifying their income streams, BHP, yes, it's paid a cracking dividend, one of the top 10 dividend-paying stocks in the world.
Yes.
But getting out of coal, their share price has really gone nowhere for the last half decade.
Yeah, coal is a big talking point right now. So what we say, like Whitehaven Coal, 2023 stock of the year. It was the stock of the year. Coal isn't going to go anywhere. We're always going to need coal. But diversifying into metallurgical coal as opposed to just thermal coal is so important. So Whitehaven Coal did the right thing. They've bought these assets that are now metallurgical coal, which is the key ingredient for steel making. And with a rebound on the horizon for China's demand for steel, they've got steel mills back and up and running. That just says that there is tailwinds in the sector, but they needed to diversify into metallurgical coal and not just be in thermal coal. Thermal coal will phase out, but I don't think it'll be gone forever because at the moment you see uranium, which is a big one, running still. You've got copper. Like coal will always play a role in our energy systems. So that's something to keep in mind when you're investing. But ESG concerns, obviously.
Yes. I mean, you interview a lot of CEOs in a lot of mining companies. So you're at the forefront, I would say, of anybody looking to get some research. Picking your brain is probably why we're sitting down here.
Yeah.
For the listeners, for mining stocks, because I know that and phenomenal pick with gold at the back end of 2023, because I think, correct me if I'm wrong, it's probably up 60% or so, just the spot price.
I think it's way more than, I don't know.
And miners are up a hell of a lot more than that.
Yeah.
So it's been a great play transitioning away from coal. I mean, I'm not sure when this podcast is going to air, but overnight, this is on the 1st of October, China's come out, and we were talking about it.
Yes.
That they've stopped the imports for iron ore, which is a large portion of the revenue for BHP.
Yep.
And the stock's only down 1.5% today. I thought, personally, it would have been down a lot more.
Yep.
What's your take on that?
I didn't see it. Like I saw it impacting, but not as heavily as what the market probably. Well, the market's got it right today. So we saw this coming a few weeks ago. We saw the initial share price reaction. It was teased a few weeks ago that BHP, China was going to stop this import, and China has kind of been toying with the idea for a while anyway. But I think in FY25 we saw so much decrease in demand from China and so many issues with China's demand for BHP's key assets that investors have gone, you know what, BHP is doing the right thing, diversifying into copper. They've got other trade partners. China isn't as relevant anymore. While it is still the major player, it is still our number one trade partner with Australia, and it's important. BHP has de-risked itself by looking at other trade options, diversifying its earnings. So I think they've really handled it really well.
Gotcha. Because here I was thinking when I was reading that last night, I'm going,
no.
Jesus, on the open, it's going to be down 5-6%. It's going to drag the entire market. But the reaction hasn't been there because they have been diversifying away from China.
Yeah, exactly.
And from their iron ore, getting into copper. You talk about gold and miners. If you had to have a tip now, where do you reckon that we're heading for Australian miners? Is it gold still?
I'm still a gold bull. I will be probably for the next 6 to 12 months. The tailwinds, as I mentioned, the drivers are still there. So you've got the central banks are still continuing to buy up and diversify reserves. They want gold bullion. You've got supply is constrained because so much is being bought around the world. High grade supply as well is a big one that you need to consider. There is obviously a weakening USD, inflation journey as well. Rate cut outlook bodes well for gold. So there's just so many things that really fuel the tailwinds for gold. So you look at it and you go, gold is still it. And investors at the moment are so reactive. Like you'll hear something on the news overnight and double-digit share price depreciation. Like Friday, healthcare stocks absolutely smashed. Even the companies like Mesoblast and Clarity Pharmaceuticals who have said we are exempt from these tariffs, the 100% tariffs that Donald Trump is supposedly imposing today. They're exempt, but investors still sold out in fear. And so the panic selling at the moment is absolutely catastrophic. It's phenomenal. I'm like, stop panic selling. Like, this is just nuts. But you can't help it as an investor. You go, I'm going to lose all my money.
Yes.
And so investors are getting it wrong so quickly. So when we look at it and we go, the outlook is still there for gold, I still definitely believe because we're in a market where people need to flock to safe haven. So instead of the banks, which are offering lower growth outlook, lower growth profiles, they're going, I'm going to store my value in gold, which is a tale as old as time. So gold for me is a big one. Copper as well.
Yep.
Copper's massive because we're going to get to a point soon, and the copper price hasn't reflected it from what I've seen on the market and spoken to CEOs as well. They're saying that the gold run was there, the lithium run was there. Copper, the undersupply we're going to face soon, and demand is just soaring, is absolutely going to be so starkly contrasted that the market has to reflect it. So with copper, it takes 17 years to get a mine into production. Lithium's about 4 years. Gold's about up to 10, but not as much. Copper is so hard to get into the downstreaming process, and it's 17 years. So we're not actually near that for any high-grade copper at the moment. There's a few miners coming online, but not enough for this supply deficit. So definitely something to keep in mind. That's where we're seeing opportunities.
Very good. And we'll talk more on copper. It's interesting that it's 17 years to get onto the market
17
for a
years,
mine.
massive.
So if there is a large demand shock, it's going to take a while for that supply to come on board, which,
Exactly.
naturally then supply and demand, naturally it's got to go one way, right?
Exactly.
You spoke about gold. The first stock I ever bought was actually a gold miner.
Really? Which one?
Back in 2008. I can't tell you the name. I was reading it. There was no, I don't even think, Google might have just started back then, but I don't even think I had it. It was the old dial-up internet. So this is going back a fair time.
No, I still remember that.
Showing my age, I had to forge, hopefully the government doesn't ever listen to this podcast. But I had to forge my age so that I could buy it because I was 16.
Oh.
But I bought a gold mining stock because I was reading something and it was around the GFC and everything. So
you did well.
Gold price was going well. So I bought into a gold miner. It was doing well. So the first $500 that I made from working at Woolies, I put it all into a gold mining stock. So I thought I was killing it as a 16-year-old.
You probably were more than me.
A little bit of a
I was shopping in retail then.
But a question I want to ask is, we're talking about buying here. I didn't sell that stock and I went to zero.
Yeah.
And not only that, with mining stocks, one of the key things that you have to be aware of is the management team.
Yes.
Because they are critical to how that stock's going to perform. Mm-hmm. Something that as a young, naive 16-year-old buying my first stock had no idea. I think I had the right play.
Yes.
In terms of a gold miner.
Yeah.
But wrong execution because I picked the wrong team, which had the wrong management team.
Exactly.
Is that something now that you look at or look for when you're investing, is who's running the show?
Absolutely. And it's so critical in mining more than any sector, in my opinion. So probably healthcare is a big one as well. But for mining, have they done it before? Have they proven themselves to do it right? Do they have geo experience, or are they a financial kind of background? There's so much to understand in mining, because you can be the best financial advisor, the best CFO, but as soon as you get to seeing the strike and deposit, if you drill the wrong way, or if you think that your stopes and your actual strike zone is different to what it is, like gangbusters, you're not going to get there. And so I've seen it time and time again with certain CEOs who come in and a management team has gone, that's where that's where we're drilling, that's what we're going to do. And if it's losing the company money, they don't care, because egos come into it and they're backing themselves and they need to justify their pay packets. And then you look at it and then this other CEO comes in and goes, nah, stop all operations. That's not good for investors. This is good for investors. That's what I back, because I go, you know what? They actually nearly, I'm talking about one person here who I won't say because they know who it is, but his experience and what he's been through, he absolutely tumbled his name because he's had an operating gold mine and went, nah, that's not high grade enough. There's one drill hole over there that has incredible results, and he's turned the company into over $1 billion market cap. It's now merged with another company. So, but in doing that, he had to tank his name and tank his reputation, because investors went, why are you turning off an operating gold mine? And he just saw something that no one else did. So those are the ones that I follow, because they're willing to ruin their own reputation short term for the long term gains of investors. But as long as they've done it before, as long as they prove themselves, don't have an ego, and they have the best intention for investors, that's what I'll follow.
That's what we always talk about here, is looking long, playing short. Always having the long-term view in mind. It's a bit like, obviously rugby league. I've got a fair few rugby league analogies, but it's like having a great coach, right?
Yes.
And we see the Melbourne Storm at the moment with Craig Bellamy and his phenomenal record where
Yeah.
he's 21 seasons in, 11 grand finals, only missed one final series.
Nuts.
Had a multitude of different players, but so much success because of, you call it the management team or you call it the leader at the top.
Yeah, exactly.
Because whatever he sees is just at the top of his game.
Yeah,
Management teams and companies are exactly the same. And as you mentioned,
100%.
mining is critical for that.
Yeah, absolutely.
It can be detrimental or
is.
very impactful for the outlook and also the share price.
Yeah, and I think transparency is bigger than ever because there is so many mining stocks around the world because there's so many commodities. There's so much like in Australia, our land is so rich with these minerals and all of that we need. But if you look at them and they, like a company for investors could be a red flag if they go and say we're doing lithium this year in a lithium boom, copper this year in a copper boom, gold, we've got gold as well. Oh, and we've got antimony now. And you just go, that's 4 commodities. What do you actually have?
Mm.
And so at the moment, I'm seeing quite a bit of that. These companies changing what they're looking for, which sometimes pays off. But if there's no clear strategy and there's no clear outlook for where your money as an investor is going, that's where you need to look and go, okay, I could be making better returns elsewhere.
Yeah. If you're not looking long.
Yes.
Right. If you're just trying to manage the expectations, investor expectations, and not having that long-term view and just always changing, swapping and changing, it's never going to be great.
Exactly.
And it's exactly the same for your portfolio.
100%.
If you're swapping in trying to chase the hot topic or the hot stock,
exactly.
It's not going to work out well for you, speaking from experience.
And trust me, I've been there myself.
Yeah. Psychology for investors.
Yeah.
I think I read a stat, and it might have come out of America again. You're probably picking up a theme that I read a lot of, market analysts and everything that comes out of the States. But I think that it might have been JP Morgan had a stat on their best investors where people had passed away.
Wow.
Because they couldn't make any changes to their portfolio.
100%.
That
doesn't surprise me in the slightest.
They had their asset allocation and they just let them run.
Yeah.
We're talking about psychology now for investors.
Yeah.
How do you get over or how do you get through that? Because it's tough.
It is tough. And getting through the psychology, I think it's hard. We were talking before, it's harder to sell than it is to buy. Like I feel like each of my stocks is my baby and I really struggle to sell. But I have a strategy now that I've kind of put in place to once a stock has it been on a bit of a run, I'll take out my initial capital investment and let the profits run. So that way I'm not really out of pocket, and I'm not as attached to it, but I still get to see it run if it runs. So that's taking a bit of risk out of the play. But for investors, I think understanding and setting limitations of what do I want to achieve out of this company? Are this macro tailwinds still there? Are there headwinds on the horizon? Are they still continuing to outperform financially in every update? That kind of justifies the investment and justifies you to stay in. As soon as you start seeing some headwinds or some kind of murkiness in the water is what I like to say. As soon as that starts happening, generally there's something causing the murkiness in the water and you want to have a look and kind of reassess the outlook for the long term.
One thing that I talk through now with clients is that if we are going in an individual stock, what's the outcome? What's the end goal?
Exactly.
What are we looking to achieve? Because then it really
100%.
helps to get there. So we can make really informed decisions,
Yeah.
which is what I'm big about. And I think I read it might have been Warren Buffett.
Yeah.
Cracking investor, obviously.
Yeah.
But he had psychology around picking stocks that if you could only pick 10 stocks to own for the rest of your life,
Yeah.
and you could only have those 10 picks, what would they be? So you really think about your choice.
Yeah, exactly.
Much more than just chasing, hot gold miner or a hot copper
Like me
miner.
right now.
Or something like that.
Yeah.
So having the end in mind
Yeah.
is important.
Yeah.
Because the sell side is hard.
So hard.
And we always talk about buy, but that sell is incredibly hard and you do get attached.
Oh, God, yeah.
It is like
every update, you're like, oh, what's happening today? Like, oh my God, it's up 5%. And I'm like, just stop watching it.
I've seen plenty of clients, one client in particular who bought into Liontown.
Oh,
Probably-
Tim Goyder operation.
Probably
Love that, man.
8 years ago at like 5 cents.
Oh,
Rode it all the way up
they won't
to,
be your client anymore. They'll be owning an island somewhere, Dale.
rode it all the way up to all-time high, sold a little bit, but still owned the majority of it and didn't sell it.
Are they still in it?
They're still in it. Yeah, they still have it. They've gone through the entire lithium, highs and lows.
Yeah.
And to them, when I talk about volatility with them, they've seen, obviously hundreds of thousands of dollars swing in a day.
Exactly.
So they've got the bias around it is their baby.
Exactly.
It's hard for them to sell.
Well, when you're in that early, absolutely. The 5-cent stock, that happens 1 in a million stocks.
Yes.
So if you're in it, I wouldn't be selling either. Don't worry.
Yes, it's obviously provided a great life for them because they did sell a portion of it,
Good.
but they still own the majority of it. And it's now that I believe you may have an insight into this,
Yes.
lithium at the moment,
Yes.
is it starting to have a rebound?
Yes, absolutely. I actually spoke to the chairman of Liontown, Tim Goyder, the other day. Fantastic operator. He's actually just ventured into Minerals 260, which is a gold miner. New play for him because he's not traditionally in gold, but if you want to see the interview, it's out there. But with his operation, so again, gets back to the management team. Have they done it before? And his leadership and what he knows and sees in assets is second to none. And so seeing what he sees through Kathleen Valley and the operations at Liontown, if you're going to be in lithium, you're going to be in Liontown or Pilbara Minerals, both fantastic companies, both really good management team, ticks a lot of boxes. But what I'm looking at is the lithium. I think we are working through that supply overhaul at the moment. Demand is coming back, and I think we'll see a rebound in prices in FY 26-27.
Nice to know if you've got some lithium stocks.
Hang in there.
Yes. For you now in the market, you don't have to be specific or you can get very specific. What do you like?
I love defense. So defense, the theme is there and it's going to keep running. So it's kind of, I actually spoke about this yesterday. It's like the AI, the start of the AI boom is the start of the defense boom right now. So what I mean by that is countries around the world are every day having to deal with these new technologies hitting the market. Drones, unmanned aviation systems or UASs, laser technology, so many different tech and hardware things that are hitting their defense streams. No longer, gone are the days of just foot and hand, men on the ground with guns. That is not happening anymore. And so these new systems are coming out daily. So countries around the world are scrambling to go, what's the latest technology? What's the latest software? How do we counter it? And that's why companies like Drone Shield, Electro-Optic Systems, Austal, different companies like that are really soaring right now, but there's so much tailwind to come. So I literally sat with the CEO, Andreas Schwer of EOS yesterday, and I said, your share price has been on a pretty hot run, 500% in a year. And he goes, it's just a start, because they've only just pivoted. They're in a pivotal point right now. They've just proven that their laser technology is the first of its kind in the world. They've debt-free now. They have a good cash balance and they are ready to go. They're getting contracts that are hundreds of millions of dollars, and that's just an inflection point for a company. So when they start turning revenue, what you want to look at for defense companies is what contracts they're generating, their pipeline. So their pipeline for EOS is 299 million already bent up for the next year. So that's guaranteed revenue coming in for them to start putting their lasers out there. So what I like about defense is that it's government backed. So we know governments aren't really going anywhere anytime soon. They're one of the safest investments you can have in your backing. So the contracts are all government. So it's stability of income, it's growth potential, and we know that government spend in defense is never going to go anywhere, if not up. So defense is what I'm liking at the moment.
Is that a little bit concerning if you're a middle-aged man with all of the defense spending, all of the wars going on around the world? There are obviously governments around the world are doing it for a reason to protect themselves.
Yeah.
Is World War III on the cards?
Oh, I hope not. God, I really hope not. I'm very happy to be living in Gosford at the moment. So I'm just happy that World War III is not on the horizon. I don't think it is, but I think that we could see some upset or some unrest coming in China, Taiwan area, different oil players looking out there. China's US, obviously trade negotiations. I think Trump at the helm is just loves a little spot fire here and there. And so I think there will be geopolitical tensions in the back of our mind for a while to come. I don't know if World War III is coming. I really hope it's not. I think that's the optimist in me. But I think there are foundations for wars to continue breaking out while there's different personalities at the helm of each country, while there's different trade negotiations going on, while commodities are so red hot. Oil, obviously, down 3% overnight because of the OPEC Plus is changing their output, input again, and you've got
Bring in
different...
another 500 barrels, I think. Or
Yeah,
500
million barrels on a day, and
Yep.
it's like they just turn it on and off like a light switch.
Yes.
So I wish it was that easy for other commodities.
Yes.
But yeah, so you just look at it and you go, there's so much at play here, but I hope World War III is not on the cards.
If you're looking to the future,
Mm-hmm.
we've just spoken about what you like now. 3 to 5 years, it's a very tricky
Yep.
market to navigate naturally.
Yep.
Defense stocks, sort of like they can be very sort of tech-like with
Cyclical, yeah.
Yes, yep. That's the word I was looking for. Thank you.
That's
Appreciate
okay.
it. But, for the next 3 to 5 years,
Yeah.
do you see that continuing to play out, or where would you be looking if you've got a sort of longer-term view around that 3 to 5 year mark?
Yeah, so I see defense will still have tailwinds. So that's kind of your growth area of the market that I would be, your higher risk but higher reward area of the market that I'd be allocating a bit to. I would be looking Australian equities. I think while they are at all-time highs right now, there are still opportunities in the market, especially in this mid-cap, small to mid-cap space. So you look at those near-term producers of copper, you look at healthcare companies that have been really undervalued since COVID. I think a lot of investors, a lot of the companies, true to form, we'll stop operations here, we'll get into masks, we'll get into disinfectants, all of that, vaccines. And so they all went hard in the COVID era. And then after COVID, they went back to what they were doing before COVID. So that's generally in that lull, they stopped making money and started spending money again. So now we're at the point where a lot of catalysts and readouts are coming. So you look at Neuron with their second drug coming onto the market soon for the treatment of 4 neurodevelopmental disorders. They've already got one generating money in Daybue, the drug for Rett syndrome. So companies that are near-term catalysts and near-term commercialization for a second drug and have a multi-drug portfolio, they're the opportunities in healthcare right now. So you look at Telix, you look at Clarity Pharmaceuticals, you look at Neuron Pharmaceuticals, Mesoblast as well, the first treatment in the world for, Ryoncil is the drug. It just got the first FDA approval for graft host disease. So, and it's not a massive market, but revenue per dose is over $1 million. So you look at that and you go, there's catalysts in the healthcare space that are really justifying the outlook for growth, and they're quite undervalued right now. Niche retailers, as mentioned before, that's really exciting me. So Baby Bunting, which is where I'm shopping every week at the moment. Nick Scali, JB Hi-Fi. JB Hi-Fi is a really good one because you got AI play there. So all the tech that's the AI boom is sold at JB Hi-Fi. So you've got that kind of diversified AI play. Data centers as well. They're not going anywhere anytime soon, and they absolutely cost a fortune to run. But if you want to play the data centers, you can play a water provider play or energy provider play because the amount of water and energy these companies need, these data centers need, is simply phenomenal. So there's a lot, like long term, I'd go a bit allocated to defense spend as my growth, and then I'd go staples like your golds, a bit of gold to bolster the portfolio and kind of keep the staple and security and safety there. And then I'd go the outlook for growth through healthcare, which is not going anywhere. Make sure they're producing in the US though in this day and age. And I'd look at your retailers and data centers.
We've spoken about, and you've spoken about, a lot of individual stocks. If we're just starting out, and someone who is just starting out, is it easier to just get into an ETF or a single sector through an ETF, or the individual stock itself? Because it can be, unless you're quite across it, you might have the right sector, but you've got the wrong management team.
And wrong stock.
Is there a way that would you look at? If you don't know, if you're just dipping your toe in, is an ETF a better way to go?
ETFs are very beneficial, but again, there are so many out there. Every man and his dog can make an ETF these days. There's listing. I actually saw the ASX team the other day, and they were saying they've had hundreds of listings of ETFs this year alone. So picking the right one is just as hard as picking a stock, in my opinion. But you look at ones in the themes that I'm talking, and you've got DFND or ARMR are the two defense ones that are out there doing pretty well. Or for the gold space, you got GOLD or NUGG, so gold and NUG. I love the names of ETFs. They're fun. They're quite fun. But those ones definitely is what you can do instead. And it's a de-risking it's a de-risking strategy for your portfolio. So if you grab an ETF in one space, then you can kind of diversify into a stock in another. So yeah, there's a lot of ways to play it, but ETFs are generally a de-risking move.
Yes, and if you're looking to get into the market, it's very hard to pick I would say that you're probably going to have 6 or 7 that you do pick are going to be losers.
Yeah, well, generally, yeah.
Yes, along the
like
way.
me when I started.
Like most of us.
Yeah.
So it can be quite hard picking an ETF if you can get the right momentum behind a specific industry and you can ride those tailwinds. An ETF might be an easier option for someone to get broader access.
Exactly. And to have that, you literally get a pool of stocks. Like you get a taste of a lot of stocks, but there are fees involved that you need to kind of research because some do sit on pretty high fees that investors may not understand before even dipping into the market. So yeah, something to keep in mind.
Grady, you weren't always in finance.
No, I was not.
You were a news reporter.
I was.
Once upon a time.
First and then news.
Yes.
Yep.
You speak phenomenally well now. And
Thank you.
Traditionally, there's not a lot of females in our industry.
No.
In finance. What piqued your interest to go from journalism to finance?
Interesting story. So my dad, growing up, we did it pretty tough. And so dad started a business back in 94 when I was born. And he actually bought a business that was dying in software CRM for real estate companies. And he has a risk appetite. Mum definitely didn't. So mum's on his back going, don't do it, don't do it, don't do it. Dad's like, another mortgage on the house, like putting us into a lot of debt. So we're having 2-minute noodles for dinner, chicken stir fry, whatever mum could make with the little that we had. And dad just saw something in the business that no one else did. And he worked 10 years to turn a profit. So that's, for anyone who doesn't understand, it's a very long time. And then Fairfax saw the company and thought, we want to buy that because it was Australia's #1 CRM in the software, if it's CRM software in real estate. And so he sold it to them. They made a lot of money, but then they ran that into the ground. And so dad had spent time with the original team because they all got let go. Building a competitive product because they only had a 90-day non-compete clause. So dad went, let's go again. So he built another one and then bought the old one back, conglomerated it all and had Australia's #1 CRM system for real estate again. And then they listed it for a short time, PropTech Group, and then got bought off the market very quickly by MRI, which is a global provider. So I saw everything from the tough days to how to build a company to turning a profit to selling it off to listing on the market. And I just loved it. And I love dad's determination. I love dad's drive. And I kind of mirror that in everything I do today. He's like my idol, obviously. So that's what I started. And when I got the opportunity in Perth to go and start doing news in finance, I thought, this is great. Like, this is fantastic. So I'll give it a go. Because sport, as much as I love sport, I'm a massive tomboy, grew up loving AFL. You look at it and you go, I was going to stories going, I know exactly how I'm going to write this before it's even happened. And for an NRL game or something, I knew how I was going to go because it's winner, loser, injuries, who they're playing next week. And that's generally how you write the story. And I'm sure everyone out there will go, oh my gosh, that is exactly how it is. Like you listen to Fox Sports News where I worked or something and it's always winner, loser, outlook, any surprises, any reports, any injuries and who they're playing next week or the outlook for the season. So it kind of got a bit redundant in my brain because my brain is constantly challenged by the markets every day now. And news reporting was the same. I was going to stories in the end going, I know the grabs I'm going to get from my interviews. I know the storyline. I know the plot. I know exactly how I want it to go. And so it gets a bit boring after a while. Sorry to any of my former employers, but I love working with you. But markets, I can wake up today and go, holy moly, Donald Trump's dropped a bomb and markets are going gangbusters. And sometimes I can't even tell you why they're going gangbusters. And that's what I love about the finance world is because something can happen overnight that will change the markets like that. And then something can happen and markets don't move. And I'm like, it plays with my head. I'm like, why aren't you moving? But you get through and it changes every day. So I think the ever-changing nature of it, the way in which I can get across so many different areas of the market and never be bored is kind of what stimulates me, I think, every day.
You can definitely tell you've got a passion for it.
Yeah, I love it.
You've got that steely-eyed, which is from your upbringing naturally, from seeing your dad go through such hard times.
Yeah.
For someone to complete 3 degrees, I take my hat off to you.
Yeah, my head said, let's not go there. Thank you, government, for indexing it every year.
Lovely. Nice of them. You've got that and you've got that drive now, and finance is a pretty hard topic to get into.
Very.
You've seen your dad run businesses and you've got that passion, you've got that drive, which a lot of people do have.
Yeah.
around businesses, around starting businesses, around investing in businesses.
Yeah.
You've been in and around it your whole life. You're naturally very good at articulating different stories because you've been a journalist.
Yeah.
I find it, if you're listening to a finance podcast or you're trying to listen to something, it's very hard to listen to.
Very, very. I love them, but it's really hard to listen to a finance podcast, especially if you don't have the understanding of finance, because anyone mentions a ratio and you're like, sorry, EV to EBITDA, and everyone's like, what's EBITDA? Like, initially I was like, what is EBITDA?
Yes, yep.
Yeah.
Looking back now at your career and where you've come from, is there a piece of advice or a lesson that you'd like to whisper to your younger self?
Absolutely. Just say yes, because you can teach yourself later how to do it. So I made an app when I was 21, and it was from a marketing assignment in my first degree. And I designed it for the Neurological Council of WA. And they actually said, can you make this? Because long story short, their client base hadn't grown in the 5 years they'd been operating, but because they had paper, like literally like paper like this, they go to clients and they would assess them, and they'd have 4 sets of the same amount of paper, and then they'd have to go back to the nurse, go back to the office, input it in. Services can take up to 2 weeks. Someone with Parkinson's can go downhill overnight. And so these people with neurological disorders were really kind of in a pipeline of stagnation for a while. So what I did was made an app to ensure that the nurses went out, assessed the clients, and it went straight to the database, straight to the government, and resources and services were referred to that day. And so with that, I thought, if I hadn't have said yes, I wouldn't have done that, and I wouldn't have had the experience I did and seen firsthand helping people in life. And so, and did I know how to code? Absolutely not. Like, I'm 21 at this rate, and I'm literally at Curtin University in WA going, yeah, absolutely, I can do that. I went home and Mum's like, what's going on? And I was like, Mum, I need to sit on YouTube for 10 hours straight watching, YouTube back in the day, coding, Xcode, how to Xcode, how to make a website, how to make a form. And I'm just like, literally in the car down south to our holiday house. How do I do this? How do I do that? So I think just saying yes is important. Like, obviously, to my detriment, I've said yes too many times to too many things, and I've burnt out over the years, but I'm getting better at saying no now. My partner will attest to that. But I think, just saying yes and seeing where it leads you is really important. And that's what I would always say to myself.
Especially in your younger self when you've got plenty of youth on your side.
Yeah,
just
exactly.
saying yes. I
you
love
don't need
that.
sleep.
No. But you've got the time on your side to take the risk.
Exactly.
And you can find out where your passion lies.
Yeah.
But coding, watching YouTube videos.
Oh, God. It was not fun.
No.
It was many, many hours. And it was back in the day when internet was not as pretty as it is now. So it was just like clunky, like put this comma here. I was like, comma. And it's like, okay, enter, like the brackets and all the code. I was like, this is so hard. But we got there.
Pre-chat GPT.
Oh, gosh, that could whip it out in a second now.
Yes. It's one thing that we, in our companies that we have is that we always want to test new things or try new things.
Absolutely.
And fail.
Mm-hmm.
Because if we can fail more, it just means that we're just a little bit closer to getting to where we need to be.
100%.
So Danny and I and the team have got to, not a running joke, but what have you failed at this week? Or what have you attempted at this week?
I think it's a really, really important thing, like failure. I've failed at so many things. Like, a lot of people have said to me, oh, you've had such an easy run, or you've had it perfect. And I was like, sorry? In year 10, I was told I shouldn't do ATAR because I was too busy elsewhere and I was really struggling at school. I then went to get a scholarship in 94 ATAR. Like, there's a lot to my story that people don't understand. And so I know I haven't had it easy, and I've failed at a lot, and I'm proud of every failure. And I think the people that don't admit to failure and don't own their failures, they're the ones that create this kind of stigma on themselves and this stress in themselves that they have to be perfect. And I'm like, I'm the first to say, no, I messed up big time. Like, in this, in that, like, so many different areas of my life, failure is a key because it's the only way you learn.
Absolutely. Life would be pretty vanilla if we
so boring.
didn't try to do anything.
Be a chocolate thick shake girl, not a vanilla girl.
When markets are quiet or boring now, what do you do to recharge?
I like to do Pilates, but this is the nerd in me coming out. I love valuing companies. So I've recently learned how to do DCFs, or discounted cash flow valuation modeling and forecasting as well. So I literally grab a company, I'll grab their fundamentals and financials from the last 4 years, sit down in Excel and spend 4 hours building what I think their valuation should be. And I know that sounds super nerdy and super silly, but I just get so engrossed in it and I go, that really is a hold rating.
Yep.
Or like it should be $3.77, not $4.12 in the share price or something like that. But I love it. Like I absolutely love it. And so I think I've found what I really love doing in life. But I do like traveling as well, naturally. Who doesn't? So
Pilates, traveling are very different than sitting down doing DCF cash flow modeling.
But I love it.
Yeah. It's for someone who just gets a tip off a mate around getting a stock tip.
Yep.
You go the absolute opposite way now.
I do it myself.
Yeah.
Well, I used to do that, but then I had one stock that absolutely burnt me. So I was like, you know what, never again. I'm just going to look at it myself and do the fundamentals and see what it actually should be valued at.
Yep. Grady, I appreciate your wisdom coming onto Your Wealth Playbook today. It's been great.
Thanks for having me. I've absolutely loved it.
Thanks for tuning in to another episode of Your Wealth Playbook. If you could help us out in any way, the biggest benefit that Jared and I and also Danny will get is if you can subscribe to this podcast on your favorite platform and maybe share it. Send it to somebody that will benefit. You'll help us. If you'd like to help us, we'd love for you to help us.
The information in this podcast is general and does not consider your personal objectives, financial situation, or needs. Before making financial decisions, consider whether it is appropriate for you and seek professional advice. Past performance is not a reliable indicator of future results. If you would like to discuss today's topic further, reach out and we would love to help.
Jared and I have not assessed your individual circumstances. Therefore, this podcast is general in nature and for informational purposes only. This is not personal financial advice. There are so many advisors and brokers in Australia. You'll find one that you resonate with, but this is for informational purposes only. Or maybe just use Jared and I.